This is part 2 of the lecture for Friday, September the 4th. Just a couple of things that we need to finish up, just to at least familiarize you with. All right, subsidiary ledgers are used quite often because general ledger accounts can become too bulky. All right, so let's say that I'm MasterCard and all these people owe me money. That would be in my accounts receivable. Well, I can't have every single thing in my accounts receivable account in my general ledger. All I really want in my accounts receivable in the general ledger is just the total of everything that's owed to me. So I have a subsidiary ledger for accounts receivable that shows individual names and how much each person owes me. Then the total of that subsidiary ledger should tie to what's in my general ledger accounts receivable. Okay, that accounts receivable in my general ledger is called a control account. Right? It'll just have like the overall totals, and then in the subsidiary ledger, I would have the details that make up that total. Another example, on campus, we have all this equipment and all these computers and desks and all that type of stuff. We can't have like a little separate account for every little thing that they own. So there's a subsidiary ledger for, let's say, equipment, and every piece of equipment and what they paid for it is listed in that subsidiary ledger. And then in the general ledger, it just shows the total of equipment that is owned. Okay? And you can have subsidiary ledgers for many different things. Generally, you're going to find them for at least accounts receivable and accounts payable, but they could also be like for the furniture account, equipment account, anything that has a lot of different accounts, okay? And they just come in handy. So here's an example of kind of how it works. So here's a subsidiary ledger, and they've got two customers that owe them money, Frank and Knox, and then the total here is what's shown in the general ledger in the control accounts. All right, special journals also help you kind of split up work and keep details kind of separated out in their own journals, okay? And this is also how software packages work. So we have been making all of our entries in the general journal. We've been recording every single entry in the general journal. But a lot of the entries have commonalities. For instance, if I have a sale on credit, every journal entry for a sale on credit is going to debit accounts receivable, credit sales, debit cost of goods sold, credit merchandise inventory. All right, every sale on credit will have those entries. So why not have a journal just for that, where I don't have to rewrite everything over and over and over again? All right, and that's what special journals are for. You can also have different people that are in charge of specific special journals. Okay, so the four most common ones that you would see: a sales journal. It records only sales of merchandise on credit. So it would always be accounts receivable and sales, cost of goods sold, merchandise inventory. That's all that would go in the sales journal. And really all you have to do is put the dollar amounts, because you already know what the debits and what the accounts are. The purchases journal records purchases of merchandise on credit. All right, so it's purchases of merchandise only on credit. Same that compared with the sales journal. It was only for sales on credit. Okay. Then anytime cash changes hands, that's going to go in either the cash receipts journal if you're receiving cash, or the cash payments journal if you're paying cash out. Okay. Oh, they don't really give us any examples, but anyway, you know what? I have one. Let me pull it up for y'all. This is something that you'll get to do in advanced accounting. Okay, so this is a practice set that we have to do in advanced accounting. And I've got some special journals over here All right, so here's the sales journal. Notice that it has one column that says accounts receivable debit, sales credit. So you just make the entry there, or put the dollar amount there, and then you put the dollar amount here for the debit to cost of goods sold and the credit to merchandise inventory. Then you don't credit each individual entry, you total them up, and you only have to post the totals. You don't have to post each individual entry, just the totals. So it makes it a lot easier and it cuts down on a lot of the work. All right, a cash receipts journal, you know you're getting cash and cash is going to be debited. So they put cash over here at the end and it's a debit to cash, all right? And then you would only have to post the total. That's it. You don't have to post every little transaction, just the total, okay? Then you have to note where it came from. It either came from somebody paying you on credit, all right? You would post the total to the accounts receivable control account in the journal ledger, and then individual amounts to the subsidiary ledger. If they're paying you on sales, you would credit sales. It was a cash sale, and you would only have to post the total. All right, if you're selling something for cash, then you would also have cost of goods sold, merchandise inventory affected, and you would only have to post the total. If it's another account, you would have to post each one individually. All right, the purchases journal is only purchases on credit. The cash payments journal is where you're paying cash out the door. So you have the credit to cash, you would only have to post the total. You would, if you're buying or returning inventory and getting cash back, I don't know what this is, paying cash. I would think that would be a debit. And then accounts payable, if people are paying you on accounts payable, you would have to post each one individually in a subsidiary ledger and only post the total. All right, so it cuts down a lot of the time and makes it easier. Okay, so let's go over here and I have a little exercise ready to go. All right, so this is exercise 14, and they want to know what journal, what special journal, or it might be the general journal, each of these transactions would go into. All right, if it's a purchase of inventory for cash, that involves a cash payment, so it would go in the cash payments journal. All right, if it's a sale of inventory on credit, that goes in the sales journal. That's the definition of the sales journal. Payment of sales salary. So if I'm paying something, cash is going out the door, that's cash payments journal. Purchase of inventory on credit. I'm not paying cash, no cash is going out the door, but I'm purchasing inventory, so that's the purchases journal. Sale of merchandise for cash. I'm selling some merchandise, but I'm getting cash in return, so I'm receiving cash, so that's the cash receipts journal. Purchase of land by issuing a note payable. All right, that doesn't really fall under any of them, so that would still be the general journal. All right, collection of short-term notes receivable and related interest. All right, I collected money, I collected some cash, so that's cash receipts. I return defective inventory to suppliers for credit to the account. Okay, so this one doesn't really fit. You know, when I bought it, when I purchased it, I put it in the purchases journal, but the purchases journal doesn't really have an option for returns, so this has to go in the general journal. Your adjusting journal entries still go in the general journal. And if I purchased equipment for cash, cash went out the door, so that would go in the cash payments journal. Okay, that is it for the Friday lectures. Y'all have a great weekend.